Central bank digital currency doesn't exactly roll off the tongue, but you might want to get used to saying it. These so-called CBDCs, or digital versions of dollars, yuan, euros, yen, or any other currency, are coming, say those who study them. And depending on how they are designed and rolled out, their impact on the banking system could be profound. So in this video, we are going to discuss Say No to Central Digital Bank. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. 114 countries are exploring digital currencies, and their collective economies represent more than 95% of the world's GDP, according to the Atlantic Council's Central Bank Digital Currency Tracker. Some countries, including China, India, Nigeria, and the Bahamas, have already rolled out digital currencies. Others, like Sweden and Japan, are preparing for possible rollouts. The US is studying the issue and has run trials of various technologies to enable a digital currency, although Fed Chair Jerome Powell has indicated the US Central Bank has no plans to create one and won't do so without direction from Congress. Over 97% of the money in circulation today is from checking deposits, dollars deposited online and converted into a string of digital code by a commercial bank. The digitization of credit and debit card transactions and the development of banking apps has moved many traditionally cash-based transactions into digital space. So far, the shift to digital has left the banking business relatively unscathed, at least in the West, where new players such as PayPal still rely on customers linking the service to their bank debit and credit cards. A few online-only banks have materialized, such as Chime and Nubank, but again, these ride on existing rails. That could be about to change. The impetus for more radical change is coming from China, whose central bank has been running an experiment with a form of cash called Central Bank Digital Currency, CBDC, which it envisions as the cash of the future, ultimately eliminating the need for paper money. In a CBDC world, the digital code for each virtual currency unit will be held in a digital wallet and transferred seamlessly by the wallet holder to other people's digital wallets, very much as we see with today's fintech and big tech digital wallets, think Venmo and Apple Pay, and the wallets offered by the traditional banks, such as Zelle, a cooperative of 6 banks, including Chase, Bank of America, and Wells Fargo. In China, these services will be licensed to 4 state banks and 3 telecommunications companies, who will act as wallet distributors rather than cash depositories. Users will scan barcodes on their phones to make in-store payments or send money to other mobile wallets. The People's Bank of China, PBOC, will periodically receive copies of customer transactions stored on a mixed central and blockchain database. The Chinese pilot began with the distribution of 100 million digital yuan through lotteries in 9 cities, including Shenzhen, Suzhou, Chengdu, Xiamen. By the end of September 2021, the digital currency pilot had recorded around 500 million transactions with 140 million users. E-yuan will be fully rolled out during the Winter Olympics in February 2022, and if bilateral agreements with foreign monetary authorities are reached, tourists and business travelers in China will be able to obtain a Chinese e-wallet on their own phones. Part of China's motivation for introducing a CBDC is to reduce the country's dependence on Alipay and WeChat, which currently account for 94% of online transactions, $16 trillion in value. It also helps reduce the threat from independent digital currencies, such as Bitcoin, which could potentially threaten governments' ability to manage their economies, not a prospect that a Chinese government would view with equanimity. How will CBDCs change banking? In the traditional model of banking, some 2 centuries old, individuals or institutions receive money from investments or pay that they deposit with banks, which then use the money to make loans, setting aside, reserving, a proportion mandated by regulators, typically 10%, available for depositors to withdraw and convert into cash. Banks make a profit on the difference between the largely short-term, interest they pay to the depositors they market to, and the largely long-term interest they receive on loans to business customers or investments in equivalent financial securities, such as corporate or government bonds. An end to paper cash and private bank deposits, with the central bank effectively becoming the sole intermediary for financial transactions. Banks would no longer compete for retail or business cash depositors, success in which currently underlies much of their market value. Instead, they will, essentially, all borrow wholesale from the central bank to finance their lending activities. The central bank thereby becomes the lender of first rather than last resort. With funding secured, interbank competition will be based entirely on the ability to recognize and price good loans and to bridge short-term and long-term interest rates efficiently, which will reduce the margins in that business to the benefit of good borrowers engaging in value-creating projects. Competition for customer deposits will be replaced with competition for distributing their electronic wallets with the most innovative and user-friendly solutions. Easier regulation and policy execution. In a CBDC world, all transactions could in theory be monitored with the help of data analytics and AI in order to more quickly identify banks that are struggling or are engaging in questionable transactions. At present, financial regulators must rely on the reports provided by banks, which means that remedial action comes late and often at a greater cost. In addition, in a CBDC world in which digital bank codes are visible to the clearing institution, it becomes much easier for the authorities to identify the parties to a transaction, which greatly simplifies the detection of criminal activity and eliminates the black markets characteristic of countries that deal largely in physical money. The cost of fraud to U.S. financial services companies is estimated at 1.5% of revenues, or around $15 billion annually. The switch also simplifies the execution of monetary policy. The central bank can immediately change supply by issuing or canceling codes in its own accounts. And by paying interest on CBDC holdings, however, the central bank can directly transmit monetary policy to households, instead of influencing commercial deposit rates through the rates it offers banks on their reserve accounts with the central bank. Today, with money held in commercial banks, the policymaker can only influence consumer and business behaviors indirectly. Greater inclusivity. Transacting with CBDC doesn't require a bank account. Important in developing countries, where typically a third of the population lack access to traditional finance and yet have access mobile internet. In the US, approximately 5% of people are unbanked. An unbanked Indian consumer with an Aadhaar number and a smartphone could easily transact over a mobile app. This means that countries in the developed world will fairly easily be able to integrate people into the financial system who were traditionally outside of it. What does it all add up to? These changes stand to take out many of the costs and risks implicit in the traditional system, which was built at a time when customers needed secure branches to deposit bags of cash. That has resulted in $1 trillion, 85,000 branch, operations, and payments infrastructure in the US that employs 1.2 million people, about a third of all truck drivers in the US. This infrastructure, which costs about $600 billion a year to run, is assumed to be necessary for handling all deposits and payments. This number is the approximately 60% cost/income ratio of US banks applied to related revenues of around $1 trillion, half of which comes from commercial banking and the rest from processing payments. But if customers no longer need to physically deposit cash, then the $600 billion annual spending on physical infrastructure is a complete waste of money, equivalent to paying 1 out of 3 truck drivers to drive around with an empty truck for a year. Beyond the unnecessary waste of the physical infrastructure, the system is slow and expensive. Payments take an average of 1 to 3 days to settle, and card processing fees eat up half of retailing profit margins. Cross-border transfers are extortionary. It can cost a migrant worker as much as $50 to wire just a few $100s home through a commercial bank. What's the catch? CBDC is not without its problems. One obvious risk is to privacy. A number of US lawmakers argue that China will use digital yuans for domestic surveillance. Central banks increase control over money issuance and gain insight into how people spend their money, but deprive users of their privacy, notes Congressman Tom Emmer, adding CBDCs would only be beneficial if they are open, permissionless, and private. Perhaps the biggest concern is with security, particularly cybersecurity. You can argue that the existing system, with multiple banks responsible for their own security, is exposed to more frequent but possibly more localized breaches of security. According to this logic, if the central bank gets hacked, then the whole system could be fatally compromised, although the risk of a breach actually occurring is perhaps reduced, given that a central bank would have the cyber expertise of its government at its disposal. Essentially, the trade-off would be between recurring but manageable breaches and highly infrequent but catastrophic ones. A central bank would definitely be too big to fail. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.